The game is rigged, but it can be learned. And have you ever wondered why some people that are rich continue to get richer and those that aren't as wealthy never get to that level? And I mean business owners, family offices, wealthy individuals. Well, once you understand it, you can learn it too, and following these steps in this video, you'll be able to get to that level, even if you're only just starting out. Well, in this video, I'm going to be going through the stages that those that are wealthy continue to use, even when they're not working as hard, even when they're working fewer hours, and not going for salary increases year on year. This isn't just service level, this is going behind the scenes and looking at the detailed structure of how it's compounded together. And stick around to the end where I'll show you how to use step-by-step instructions to build this foundation for yourself. Part one of this is actually going to be looking at capital velocity, and this is where you're using your money and making it work for you. Most people that are wealthy don't just save money, they don't hold it in their banks because it's not making it work for them. What they'll do is they'll continually invest that money into different hedge funds and accounts, private equity, and they can do this and that will generate returns on their money more than what they get interest within the banks. When you continue to move it and you do so strategically for future benefit, this is what is called capital velocity. And it's one of the key differences between middle class and the upper class and wealthy. Now, most people in the middle class tend to earn their money through their salary, working longer hours and getting pay rises. So you've earned it, you then save it, whether you save that in a personal bank account or you do invest some of that into stocks and shares. You will then spend it on things such as your house, car, things and luxuries that you like to buy. And then you either need to repeat the process to get more money, or you're at the age of retirement and the time frame is gone. What the wealthy do is that they leverage their money to acquire assets. They'll then generate cash flow from that, and they'll use that to repeat this process to generate more cash flow and more leverage and to purchase more assets. Money is generally treated like energy. It's not hoarded, but it's used and spent to generate more. And every pound and dollar has a job, whether it's used to spend to get further capital investment or it's used to save taxes. When I worked my days in corporate audit, I worked with so many clients that didn't necessarily hold that much cash. They had a lot of their cash built up in assets, and those assets were generating regular cash flow and regular income. And additionally to that, generating income on a monthly and annually basis, those assets were also growing in value. So if they ever wanted to liquidate and move out of those assets, they would have gained profit on those assets as well. One of the key things that people don't necessarily talk about on channels and platforms like this is actually the wealth structure. So most people think that all the assets are just held in the person's name, they own all of the assets, and then when they come to sell it, they get the money personally and pay taxes on that. But actually, it's much more in depth and is that much more of a complex structure than you might think in order to make it beneficial to the owner and also in order to save taxes and generate future wealth. One of the key things that you'll find is you always have a holding company that sits at the top of the chain, and that holds all of the assets. You then might have an operating company that sits underneath the holding company, and that generates and works on the day-to-day basis of that holding company. This generates a legal separation between the operating company and the holding company, and also it means that there can be several tax advantages by holding them in two separate structures and two separate companies. What you then find is that the income that is generated off the operating model and off the holding company that's holding the assets is then pushed through into either stocks and shares, it could be into further assets, or it could be into deals such as private equity deals, which would generate future income, and it also means that the money is in theoretically safer hands than being in the bank, which means that you can generate more wealth long term. And also there's so many legal benefits to having two separate structures. By having an operating company and a holding company, you protect not only yourself, but you protect the individual companies from any legal battles and tax benefits that you may face going forward. And as I've touched on in previous videos, if you're a sole trader, one of the benefits of setting up a limited company in the UK or an LLC is that it protects you as a director and shareholder. Now there are certain circumstances where you as a director can be personally liable for things. However, the company means that you're limited liability, which means that if you've got issues in the company, they can take the company down, but you can't be personally liable. So it's a great way, great defense mechanism to protect yourself. And the aim of this is not to make it complex, it should be relatively simple. It's just a way of protecting yourself. One of the most misunderstood things in middle class is that debt is bad. People don't like being in debt. People always like to pay off their debt. They don't like to be in debt with their houses, debt with their cars, debt with credit cards, and it can be seen as bad. However, there is such thing as good debt. And good debt is really important to you, where you're leveraging the debt in order to generate future cash flows. Now, I always say, especially when you're starting out, is never to borrow more than you can afford. So if you're spending £10,000 on a credit card and you've only got £5,000 in your bank, you're over leveraging yourself, and that means you're putting yourself at risk. However, if you've got £5,000 in your bank and you spend £2,000 on a credit card and you can clear that credit card at the end of the month, that for me is seen as good debt, because whilst you're using your credit card and the bank's money, your money that's sat in the bank is generating interest, which is therefore offset, and you're actually making money off the bank. Now, what people will often do when you're wealthy is actually leverage against property. So you'll put down, for example, a 20% deposit on a property. That property gains in value, and then what you can do a refinance to take out 30% of the property's value. So you get your original 20% back, a further 10% back, which you can use to reinvest into elsewhere, whether it's another property or another asset. And then you've still actually got your asset that you originally purchased, which is continuing to gain further funds, continuing to grow in value. And what you can do is you can rinse and you can repeat this process over and over again to generate more assets in your portfolio and continually freeing up cash flow in order to invest into new assets. So the summary of that is that the debt isn't dangerous if it's backed by cash flow. If you've got current cash flow or future cash flows which can support the level of debt that you're going to be financing, then debt can be good for some people. An example of this would be if you invested £200,000, so a 20% deposit into a £1 million property. The £1 million property then went up to 1.2 million over a couple of years. You refinanced and you took out 30%, so it's 300,000. You got your original £200,000 back. You've got an additional £100,000 back, which you can then use to invest into a future property. And you've still got your property that's worth 1.2 million or 1.3 million, and that will continue to grow over many years, however long you hold it. And you can continue to repeat this over and over again. So there's so many tax strategies that feel like you're cheating the system, but actually aren't. And a lot of them are not well known. And the problem with this is that people lack the knowledge to understand the different tax structures and tax schemes that you can actually use in order to benefit yourself. And what you'll find is that the wealthy don't just make a lot of money, they actually keep a lot of money, and they do this by setting up tax structures that means avoid the amount of tax that they need to pay at the end of the year. For example, in the UK, there's things called patent box, and if you've got a new startup business that generates revenue off patents that you've got registered in the UK, you can pay lower level of taxes on the revenue that's been generated from that patent. So if all of your revenue has been generated from that patent, you can pay a lower level of tax than everybody else in the UK. Additionally, there can be R&D tax incentives. If you're doing an R&D product, an R&D project, what you can do is you can generate tax savings off that R&D, all the expenditure that you've made, and you can offset that across the group of companies that you've got. There's also donor advised funds, and this is where you propose to donate funds later on in the year or in future years, and that means that you can avoid paying tax on the money now on the premise that you'll donate in the future. And there's also things such as dynasty trusts. Now, dynasty trusts are long-term trusts where the assets in the trust flow through multiple generations, and it can be a way to avoid paying taxes if you're going to hold on to those assets for a long period of time and pass them on into future generations. An example is that Amazon in 2018 actually paid $0 in corporation tax, and they did this by using depreciation, stock options, and R&D tax incentives to offset all of the tax that they made on the profits they'd already earned across the group companies. So there are so many tools available, whether you're just starting out or whether you're a multi-billion-dollar company, in order to pay less taxes and keep more of the money that you earn. And in terms of building your own wealth status, starting now, like a lot of these you might think, oh, this is way further down the line than what the position that I'm in now. However, you can start today, and you can do this in the US opening up Roth IRAs, or in the UK opening stocks and shares ISAs to invest money rather than it sitting in the bank, where hopefully you'll generate more income through dividends and interest than you would have done by it sitting in the bank. Starting up either as a sole trader or moving into a limited company, which is some of the videos that I've already touched on in the past. And that means that you can start to generate income through side hustles, and you can use some of these tax benefits through those limited companies that you've now created. You can start small real estate investments. For example, the one I just showed you in terms of investing 200k on a 1 million property. You can do that on a much smaller scale. Why not invest 20k on a 200k property? Again, let that grow in value, refinance and push it into another property and generate a portfolio of properties that you've now generated. Or you can work with a tax specialist or a tax accountant, where you can either set up trusts or you can set up structures such as a holding company and operating company in order to benefit you as your company grows long term. So there are multiple things that you can do now that will actually benefit you in the future, even if you think that some of these things aren't quite ready for you now. I've actually just started a monthly mailing list, so what I'll do is I'll link that down below, and you can follow my link tree to sign up to that mailing list. And every single month I'm going to be sending out some tips and tricks that you can use in order to benefit your companies, whether you're a sole trader or you're a limited company, whether you're just starting out or whether you're a multi-billion-pound company. And also there's going to be news and facts on there about some of the latest tax and audit implications that are in the news today. Just highly recommend that you sign up to that. Hopefully that's going to be really useful for you, and it'll give you some additional benefits on top of these videos and some additional knowledge that you can take away and learn for yourself. There's so much knowledge out there that I wish I'd learned before I started audit, and you can learn this now before you've started your business, which is such an advantage over everybody else. You need to stop thinking though like an employee of a business and actually moving into that director mindset, an investor mindset, as if you're running your own company. And how would you want it to run? How much tax would you want to save? How much income do you want to generate? And how would you set up your structure so that you can get the most benefit out of the money that you're making? So please make sure you subscribe to the mailing list, subscribe to the YouTube channel, and there's going to be plenty more videos like this to come.